Hi everyone, a lot of talk lately about gold and silver getting hit by these fast-moving headlines in the Middle East. And in this video, we're going to separate the scary part from the useful part, because by the end of this, you should feel a lot calmer, a lot more informed, and a lot less likely to get shaken out by one ugly trading day. And today is Tuesday, May 5th, New York time. Do me a favor and comment what day and date you're watching from, because markets move fast, but this community is watching from everywhere. Also, if you value this content, support the channel by subscribing and commenting John AG Best. That's it. Short and simple. It tells me you're here for the real breakdown, not the panic version. So in case you missed what happened, silver was trading up in the mid-70s. Gold was already acting heavy. Oil was catching a bid. And then the whole screen started looking like somebody hit the emergency button. Silver dropped toward the low 70s. Gold slipped. Stocks came under pressure. Crypto looked nervous. And immediately the internet did what the internet always does. It took one move and tried to turn it into the whole story. But is that really the whole story? I don't think so. And this is where we have to slow down. The first thing to understand is that there were two layers happening at the same time. One layer was the actual market structure in gold and silver. The other layer was headline risk around the Gulf, the Strait of Hormuz, and reported attacks involving Iran, the UAE, shipping routes, and a disputed claim about a U.S. naval vessel. Some reports said Iranian media claimed missiles hit a U.S. vessel near Jask, while Washington denied that any U.S. Navy ship had been struck. So before anyone builds an entire metals thesis on the first headline they see, remember this: early war reporting is messy and markets often move before the facts are clean. Now, that does not mean the headlines were irrelevant. They were very relevant. We are talking about one of the most important energy corridors on the planet. The Strait of Hormuz is not just some random strip of water on a map. A huge share of global oil and liquefied natural gas moves through that region. And official energy data shows flows through the strait have been roughly equal to about 1/5 of global petroleum liquids consumption. So when traders hear about missiles, drones, ships, fires, or blocked transit anywhere around that route, oil reacts first, inflation expectations react next, and then everything tied to rates, risk, and liquidity starts moving. And that is exactly why you can see gold and silver fall on a headline that sounds bullish for safe haven assets. That confuses people. They say, wait a minute, if geopolitical stress is bullish for gold, why did gold go down? Well, because markets do not move in a straight textbook line. In the first wave of a shock, investors sometimes sell what they can sell, not what they want to sell. Funds cut leverage, traders raise cash, algorithms hit bids, risk managers reduce exposure. So metals can get dragged lower before the bigger safe haven logic has time to reassert itself. That is not a broken thesis. That is a liquidity moment. Let me say it another way. If a storm hits and everyone runs toward the exit at the same time, even the people holding umbrellas can get pushed around. The umbrella still works. It just doesn't stop the crowd from moving. So the question is not, did silver dip? Yes, it dipped. The question is, did anything about the larger setup actually change? And when I look at the broader picture, I still don't think it did. Based on recently published numbers, the silver market is still expected to remain in deficit, and industrial demand is still the main engine behind that setup. We're talking solar, electronics, power infrastructure, defense, medical uses, and all the little hidden applications where silver is not optional in the same way a piece of jewelry might be optional. The latest industry outlook still points to another sizable annual shortfall, even with recycling improving and some price-sensitive demand cooling off. That is very important, because it means silver is not only being carried by coin buyers or social media excitement. There is a real industrial backbone under this market. Now, does that mean price cannot fall? Of course not. Silver can fall hard. Silver is famous for falling hard. It can make a strong person question every decision they've ever made before breakfast. But volatility is not the same thing as weakness. And that brings me to the chart. When people look at a silver drop from the mid-70s into the low 70s, it feels dramatic. And on a short-term chart, it is dramatic. But if you zoom out, the longer-term average price of silver has been moving higher. That matters. A market that is making higher long-term averages is not the same as a market that already blew off, collapsed, and died. This is why I do not like the simple bubble argument. People see a strong move, then a correction, and they immediately say bubble popped. Okay, maybe. But where is the collapse in the underlying demand? Where is the destroyed structure? Where is the long-term average rolling over and giving up? I'm not seeing that yet. What I'm seeing is a market that ran hot, got crowded, shook out weaker hands, and is now testing whether buyers are still willing to defend higher levels. That is a very different thing. Could silver drop into a lower zone before turning again? Yes. Could it scare people first? Absolutely. But the big distinction is between a normal correction inside a bull market and a true trend failure. Those are not the same. And honestly, corrections can be useful. I know nobody likes hearing that when their account is red, but it's true. A market that never corrects becomes unstable. It pulls in late buyers, leverage, hype, and bad habits. A pullback clears some of that out. It forces people to decide whether they are investors or tourists. If you're successful, share your success story in the comments so others can stay motivated. There are people watching this right now who are trying to learn how to stay patient, and sometimes hearing from somebody who survived volatility is more helpful than another chart pattern. Now let's move to gold, because gold is giving us a slightly different message. Gold has already had a huge run, and recently published demand numbers show total demand reached a record level last year, with investment flows and central bank buying doing a lot of the heavy lifting. Central banks did not buy at that scale because they were trying to win a weekly trading contest. They buy because reserve diversification, currency risk, sanctions risk, and long-term trust are real issues. Even when official buying cooled from the extreme pace of the prior years, it remained well above the older long-term average. That tells me something. Big institutions may slow down when prices run hot, but they have not abandoned gold. They are still treating it as strategic. Now here's where I want to push back against one popular idea. Some people say every crisis means gold must instantly explode higher. No, that is too simple. Gold can be squeezed between safe haven demand on one side and rate pressure on the other. If oil jumps and inflation expectations rise, the market may start thinking the Fed has less room to cut. That can push the dollar or yields around, and gold can get caught in the middle for a while. So, once again, the timing can be messy even when the long-term logic is strong. And inflation is really the bridge between the short-term headline and the long-term metal story. The latest official U.S. inflation release showed annual inflation moving back into the low threes, with energy prices doing a lot of the damage. Energy costs were up sharply over the year, and gasoline had a very large monthly jump. That matters because energy does not stay neatly inside the energy column. It moves through shipping, food, manufacturing, airline costs, consumer behavior, and business margins. So when oil spikes because of geopolitical stress, that is not just an oil story. It becomes a household budget story. It becomes a central bank story. It becomes a real interest rate story. And real interest rates are where gold and silver investors should be paying very close attention. You can have a headline interest rate that looks decent, but if inflation is eating faster than that, the saver is still losing purchasing power. That is the quiet pressure that pushes people toward hard assets. Now we also have the debt side. The latest budget projections show large U.S. deficits continuing, with debt held by the public already around the size of the economy, and projected to move higher over the next decade. Interest costs are one of the major reasons this gets harder. When debt is small, rising interest costs are annoying. When debt is enormous, rising interest costs become a steering wheel. Policymakers have less room to maneuver. This is what people mean when they talk about fiscal dominance. It is not a patriotic phrase. It does not mean the country is dominating the world in some positive way. It means the debt situation begins to dominate policy choices. The government wants one thing, the central bank wants another thing, the bond market wants something else, and the math sits there like a referee nobody can fire. That is why these very high gold scenarios keep coming back into conversation. I am not saying every extreme target is guaranteed. I am not saying gold must go to some wild number next week. But I am saying the conversation is no longer ridiculous, because the balance sheet problem is no longer small. One idea people keep discussing is gold revaluation. The basic thought is this: if a government owns gold, and that gold is carried at an old official value, then marking it much higher could create accounting room. Does that solve the real problem? No. It does not fix deficits. It does not build factories. It does not make energy cheaper, but it can buy time. And in finance, buying time is often the first objective. But here is the catch. You should not build your entire metal strategy on one dramatic policy event. That is too narrow. The stronger case is layered. Gold has central bank demand. Gold has fiscal stress. Gold has inflation sensitivity. Gold has geopolitical insurance value. Silver has all of that monetary emotion, plus an industrial demand base and a much smaller market. That combination is why the setup remains interesting even if tomorrow's headline is completely different. Now, what happens next? In the short term, probably more chop. I know that is not the exciting answer, but it is the honest one. We could see sharp rallies. We could see sudden drops. We could see gold hold better than silver one day and silver outperform the next. We could see oil move the entire inflation conversation again. And we could see traders overreact in both directions. So what should you watch? Watch whether silver keeps defending its higher long-term structure. Watch whether gold holds up even when rate cut hopes fade. Watch whether ETF flows stabilize. Watch whether central banks keep accumulating. Watch whether energy pressure feeds into inflation data. And watch the Strait of Hormuz, because a region that important to global energy can turn one headline into a multi-market reaction very quickly. But please do not confuse watching carefully with panicking constantly. A lot of people lose money not because their thesis was wrong, but because their emotional time frame was too short. They buy a long-term asset with a long-term story, then judge it every 5 minutes like it's a meme stock. That is a recipe for stress. And one more thing. I know it is tempting to look for one perfect line on a chart, one analyst target, one magic date, or one dramatic headline that explains everything. But markets rarely work that cleanly. Gold and silver are being pulled by several forces at once. Some are bullish, some are temporarily bearish. Some matter today, some matter over years. So the goal is not to predict every wiggle. The goal is to understand whether the main forces are getting stronger or weaker. Right now, I see stress in energy, stress in budgets, sticky inflation, continued reserve diversification, and a silver market where physical demand is still doing real work. That is not a calm backdrop, but it is also not a dead backdrop. It is exactly the kind of backdrop where patient investors can feel uncomfortable for stretches and still be positioned correctly if their process is sound. That is the part most people forget when headlines get loud fast. So putting this all together, today's message is simple. The headlines are serious, the volatility is real, the risk is not fake, but the bigger metal story is still intact. Silver still has a supply-demand argument. Gold still has a reserve asset argument. Inflation is still sticky enough to matter. Debt is still large enough to matter. And geopolitical risk is still high enough to keep hard assets relevant. That does not mean you chase. That does not mean you use reckless leverage. That does not mean you ignore downside. It means you separate noise from signal and act like an adult in a market that is trying very hard to make you emotional. You do not want the world to break. You do not want markets to freeze. You do not want a situation where nobody knows what anything is worth. The better outcome is a functioning market that slowly reprices hard assets more honestly. That is what I would rather see. So yes, volatility goes both ways. It can make you feel brilliant on Monday and foolish on Tuesday. But if the long-term drivers are still there, one ugly candle is not the judge, jury, and executioner. Stay patient, stay informed, keep your risk under control. Subscribe if you want more grounded metals breakdowns, and keep commenting because I do read what you guys are thinking. And just to be clear, this is for education and market discussion only. I'm sharing how I'm thinking through gold, silver, inflation, energy, and debt. I'm not telling you what to buy, sell, or hold. Your money has to fit your own plan, your own risk tolerance, and your own life.